Nathan manages his investments actively every single day. Grace put her money in an index fund 5 years ago and never looked at it again. Nathan has more trades, more research, more strategy, and more effort than anyone he knows. Grace has a password she can barely remember. Nathan is losing, and the margin by which Grace is beating him will make every finance podcast you have ever listened to feel like a waste of time. Let's run the real math. Let's make this completely fair. Nathan and Grace are the same age, same city, same income. They both start with $50,000 to invest. They both add $600 a month. The only difference is what they do with it. Nathan opens a brokerage account and gets serious. He reads earnings reports. He follows market analysts. He watches financial news every morning before work. He rebalances his portfolio quarterly. He moves in and out of positions based on momentum signals. He subscribes to 3 premium research services. He spends roughly 10 hours a week managing his investments. His coworkers think he is the smartest person in the room when it comes to money. He thinks so too. Grace opens a brokerage account and buys a total market index fund. She sets up automatic monthly contributions of $600. She turns off notifications. She does not read earnings reports. She does not follow market analysts. She does not watch financial news. She spends roughly 0 hours per week managing her investments. Her coworkers ask her what she invests in. She says an index fund. They change the subject immediately. Nobody thinks Grace is the smartest person in the room. On day one, Nathan has a strategy, a watch list, a premium subscription, and a plan. Grace has a confirmation email and a password. This is not even close in terms of who looks like the serious investor. But looking like a serious investor and being a profitable investor have never been the same thing. Here's the concept that makes this counterintuitive before we run a single number. The stock market is not a place where effort produces proportional results. In almost every other area of life, working harder produces better outcomes. Study more, get better grades, train harder, perform better, work more hours, earn more money. The stock market breaks this rule completely. More effort in active investing does not produce more return. The data shows it almost always produces less. Here is why active investing underperforms passive investing structurally. Every time Nathan buys or sells a position, he pays transaction costs, small individually but significant cumulatively over years. Every time he sells a winning position, he triggers a taxable event. Short-term capital gains are taxed at ordinary income rates, up to 37% federally. Grace almost never sells. Her gains compound tax-deferred until she decides to take them. Nathan also faces the spread. When he buys a stock, he pays the ask price. When he sells, he receives the bid price. That gap costs him money on every single trade. Multiplied by hundreds of trades over years, the spread alone is a meaningful drag on returns. And there is the subscription cost. 3 premium research services at roughly $50 to $150 per month. Each means Nathan is spending $150 to $450 per month just to have access to information that the market has already priced in by the time he reads it. Over 10 years, that is $18,000 to $54,000 spent on research that statistically does not improve his returns. But the biggest cost is not transaction fees or taxes or subscriptions. The biggest cost is behavioral. Nathan makes decisions. Every decision is an opportunity to be wrong. When the market drops 20%, Nathan sees his portfolio shrinking and feels pressure to act. He moves to cash to protect his gains. He waits for the bottom. He misses the recovery. He buys back in higher than he sold. This pattern, selling during fear and buying during greed, is the single most documented wealth-destroying behavior in all of investing, and it is only possible if you are actively managing your portfolio. Grace cannot panic sell. She barely remembers her login password. Her inaction is not laziness. Her inaction is her strategy. Let's look at year 5. Nathan has been actively managing for 5 years. He averaged roughly 6% annual return after fees, taxes, and behavioral costs. His portfolio is sitting at approximately $125,000 to $135,000. Grace has been doing nothing for 5 years. Her index fund averaged roughly 10% annual return. Her portfolio is sitting at approximately $148,000 to $162,000. Grace is already ahead by doing nothing against someone who spent 10 hours a week for 5 years managing his investments. That is 2,600 hours of Nathan's life, producing a worse result than 0 hours. By year 10, the gap widens significantly. Nathan's portfolio with consistent 6% returns is sitting at approximately $218,000 to $238,000. Grace's portfolio with consistent 10% returns is sitting at approximately $310,000 to $340,000. Grace is ahead by roughly $90,000 to $100,000 at the 10-year mark. From doing nothing, here is what is happening underneath the surface. Nathan's 6% return versus Grace's 10% return looks like a small difference. It is not a small difference. On a $50,000 starting balance with $600 monthly contributions, the difference between 6% and 10% annual return over 20 years is not 4%. It is not even double. It is the difference between approximately $400,000 and $700,000. A 4% return gap produces a 75% wealth gap over 20 years. That is the compounding multiplier working against Nathan and for Grace simultaneously. By year 15, Nathan's portfolio is sitting at approximately $348,000 to $378,000. Grace's portfolio is sitting at approximately $572,000 to $622,000. Grace is ahead by roughly $220,000 to $240,000. Nathan has now spent approximately 7,800 hours managing his investments. That is nearly 4 full years of working hours. And he is $220,000 behind someone who spent 0 hours. If you valued his time at even $30 an hour, he spent $234,000 worth of his time to produce a result. $220,000 worse than doing nothing. He paid more in time than the gap itself. By year 20, the final numbers are in. Nathan's portfolio at 6% average annual return is sitting at approximately $525,000 to $575,000. Grace's portfolio at 10% average annual return is sitting at approximately $920,000 to $1 million. Grace is approaching $1 million. Nathan is not. The gap between them is approximately $395,000 to $425,000. Nathan spent 10,400 hours to get there. Grace spent 0. Now, before this sounds like a simple argument for being lazy, the data behind these numbers deserves to be explained properly, because this is not an opinion. This is one of the most extensively studied phenomena in all of financial research. The S&P 500 index has returned approximately 10% annually on average over the last 50 years. Over that same period, the average actively managed mutual fund has returned approximately 6% to 7% annually after fees. Approximately 85% to 92% of active fund managers underperform their benchmark index over any one 5-year period. These are not amateur investors making emotional decisions. These are professional fund managers with teams of analysts, proprietary data, and billions of dollars in resources. And still, 85% to 92% of them lose to the index over 15 years. If the professionals cannot beat the index with all those advantages, what makes any individual investor think they can? The answer, almost always, is overconfidence. People consistently overestimate their ability to predict market movements. People consistently underestimate the impact of fees and taxes on returns. People consistently remember their winning trades and forget their losing ones. And people consistently underestimate how much their emotional reactions cost them during volatile periods. Here is what Nathan was actually doing during those 10 hours a week. He was consuming information that was already priced into the market before he finished reading it. Modern markets process information in milliseconds. By the time Nathan reads an earnings report, adjusts his thesis, and places a trade, the information has been fully absorbed by the market. He is not trading on information. He is trading on news. And news is always late. Grace's index fund owned a piece of every company Nathan was researching. When Nathan correctly identified a winner, Grace owned it too. When Nathan incorrectly bet against a company that then rose dramatically, Grace owned that too and benefited. Grace did not need to be right about any individual company. She just needed to own all of them. There are situations where active management adds value, and pretending otherwise would be intellectually dishonest. Tax loss harvesting done systematically can improve after-tax returns meaningfully. Factor investing tilting towards small-cap value or momentum has shown persistent premiums in academic research. And investors in the accumulation phase who are willing to hold concentrated positions in individual companies for very long periods, think decades, not years, can outperform an index. But these are specific, disciplined, long-term strategies, not daily trading, not premium subscriptions, not quarterly rebalancing based on market signals. Nathan and Grace both wanted the same thing. They both wanted their money to grow as efficiently as possible. Nathan thought effort was the path to efficiency. Grace understood that in investing, the path to efficiency is removing yourself from the equation as much as possible. The market does not reward effort. The market rewards patience, low costs, diversification, and the discipline to do nothing when every instinct tells you to act. Grace had all four. Nathan had none of them. So the next time someone shows you their trading setup, their watch list, their premium subscriptions, and tells you they have a system that beats the market, ask them one question. What is your annualized after-tax return over the last 10 years compared to the S&P 500? Because the answer to that question tells you everything. And most people who are asked that question have never actually calculated it.